Good evening, ladies and gentlemen. Welcome to Reference Point. I'm your host, Dave Kocharhook. We're here at the early part of 2009, and there's a lot of interesting things going on in the economy. I think everybody understands there's problems with values of homes, foreclosures, things that are going on with loan modifications, etc. So tonight, we're going to be talking about this whole area of what's happening in that part of the real estate environment. What can we do about loan modifications? What do folks who may be foreseeing they might be having a problem, what can they do? And so tonight we're actually going to be doing two shows on this. There's this one and the one you'll see next week. My guests will be back and we're going to be talking more and more about this because this is a very large and expansive topic. But I'd like to introduce my guests this evening. First, I'd like to introduce Keisha Woods. And Keisha is joining us from a nonprofit organization called EPA CANDO, which stands for
East Palo Alto Community Allowance and Development Corporation, and thank you for having me here.
Well, you're welcome. I appreciate you being here. So tell us just quickly what EPA CANDO, what its mission is.
East Palo Alto Community Allowance Development Corporation is a nonprofit. It was developed for affordable housing. So that's the main thing we do is develop affordable housing. Now we're also going into the arena of foreclosure counseling. We do home buyer ownership counseling. We have a Next Step housing center where we take first-time home buyers and we put them into financial literacy classes, and they go through a period of 6 weeks, and then after the 6 weeks, then we say that they are ready for home ownership, and we refer them to a lender and get them pre-qualified.
Well, that's great. Now tonight we're going to be talking a lot about that one area that you deal with, which has to do with loan modifications and helping people who might be involved in the foreclosure process, because that is at this point apparently a fairly significant part of what your organization needs to deal with. Is that correct?
Yes. Right now, that's probably one of our main focuses, foreclosure counseling. We received a grant through the federal government to offer free foreclosure counseling to people in the Bay Area.
Fantastic. And we're going to talk a lot more about that as the evening goes on. My other guest has been a regular here on Reference Point, Narbik Karamian, who's in the mortgage lending side of things. And his company, Arvest Financial, is prevalent in that arena. And we see you all the time on regular TV and in the newspapers, Narbik. It's fabulous that you're getting some recognition for some of the wisdom that you've been able to share here on Reference Point over the last year.
Well, thank you, Dave. I appreciate the compliment, and it's always good to have being here with you. So hopefully we'll be able to share some of this wealth with the public and the viewers.
I think so. I think we've got a lot to talk about. Where I'd like to start this conversation in these, I'm going to mention two things, and I think they kind of tie together here, and this should be a jump-off point for us. The first is that we've been hearing more and more about these what are called pay option arms or adjustable rate mortgages as being the second wave of the challenge in the home lending industry. We had the subprime situation, and Narbik, when you were here back in August, we talked about the subprime situation, and then mentioned that this was going to be coming down the pike, and I don't think people had known too much about that. But I want to talk about that, and I also want to talk about how this relates to the housing rescue bill that was passed by Congress back in
October.
July, October was it? Because that was supposed to be the solution or a solution to this problem, and it seems to me that we didn't quite have the solution, but we got a bigger problem coming down the pike. Am I overstating this, or is
No. Right in 2008, we had a lot of foreclosures, but 2009 with the resets that are coming forward, we see just as many foreclosures happening.
Just as many?
Yes.
Okay. Now tell us about this concept of reset. Let's define what these pay option arms are and what the reset thing means.
Well, a pay option arm standing for adjustable rate mortgage, especially the one that is defined as pay option, as a synonym for it, also called negative amortization loan. These loans, as we mentioned in your previous segment, was primarily given to a category of people where they call the ultra rich. Mm-hmm. And the banks knew that if they offered loans at extremely low interest, somewhere around 1-2%, then the person who would be taking this loan would take that savings and obviously invest it in some other kind of an investment. So that was the whole concept of negative amortization, and it was exclusively offered to high net worth clients.
But not anymore.
Anymore. When the dot-com crash took place back in the 2000, then the banks decided to open this up to the public, seeing how that would work. And it was interesting what a big demand it created, not knowing what the consequences to that would be, which is obviously what we're going through right now.
Right. So you brought a chart here that talks about these adjustable rate mortgage reset schedule and tied into the pay option arms and whatever. And I think one of the things that's powerful about this is it really shows this huge spike coming up here. There's some dates down at the bottom of this thing. But maybe, Narbik, Keisha, maybe you guys could help explain what this means relative to what we can expect to have happening over the next couple of years.
Well, I'll go over it a little bit, please.
Okay.
Feel free to interject whenever you want. You know, we've gone through this. As we can see, this chart or graph starts from January of 2007.
Okay.
And the gray area reflects the subprime arms, which was primarily the subprime crisis which we went through, called the 228 loans, which were loans that were fixed for 2 years and 3 years.
Okay.
Not knowing what would happen after the 2-year time frame, where the rates would pretty much double. So if somebody took a 2-year fix at 4 or 5%, the rate would adjust to somewhere around 7 to 8%. And this is what happened when the subprime loans started adjusting. You saw how many of these started resetting, and this is how much volume of the subprime loans were going to reset. And we went through this, as we know, right on the dot towards the end of towards the end of 2007 and all the way through 2008. You know, we heard about it on the news and on the radio.
Right, that was the big thing.
And now it's the quiet before the storm, before the pay option arms or the negative amortization loans start recasting. Now I'd like to explain a little bit about recasting. The negative amortization loans, once they hit 110% of their original loan amount, then that minimum payment, which was the little payment that the people who took these loans were allowed to pay, goes away.
Right.
So the payment automatically doubles or goes into a fully amortized payment. And this is what we're going to see somewhere around 2009
That's
going
what
into
this
2000.
resetting and stuff's all about. Okay. So did people understand this when they got into these things?
No, from counseling people, people did not understand it. We had there were loan officers and brokers that were selling these loans and not educating the consumer. So right now, what you have a bunch of people with these loans, and they might have had an initial payment of $2,800, and then it jumps up to $4,800,
which is huge.
Which is huge, and they received this loan on a stated income transaction.
Stated income means they didn't have to prove that what they were making on their job or whatever it happens to be.
They would state
right?
it on
the
the
application, and they would take that for what it's worth. Now, one of the things that I'm curious about with respect to this, a lot of people were taking these subprime mortgages and then the pay option arms, etc. Were they looking at, I'm going to buy a house and I'm going to live in it forever, or were they looking at how they, hey, in California real estate goes up forever, and therefore they were going to try to roll it over in a couple of years?
Well, the whole concept of the pay option arm was for short-term investments. It was for folks, I'll give you an example. It was good for somebody who wanted to buy a huge apartment complex and to have a very low payment and utilize the positive cash flow from the rent, not only to pay the mortgage, but also utilize some positive cash flow for himself. But if we take that, if we take that concept and put it into our primary residences, it doesn't work too well, unless you're hoping that your house is going to appreciate so much where you can sell your house at a profit by having made a minimum amount of mortgage payment, which obviously what's happening right now, I think Keisha can explain a lot better how values are fluctuating in the...
Yeah, let's talk about that. What's happening with the values of homes and things, and how does that impact these people with these kinds of mortgages?
Well, right now, because the pay option arm is a negative amortization, so the principal is rising. So each month you have a principal balance increase on your loan. And in this type of market, right now you have depreciation. So you have depreciation and then you have your principal rising at the same time.
Okay, so the value of the home is actually going down, it's depreciating, right?
Correct.
But this thing about the principal increasing. If I understood that correctly, when you guys were telling me about this a couple of weeks ago, the mortgage companies or the lenders had these teaser rates of say 1%,
1%.
but the actual mortgage was going to be what, 6 or 7 or something like that. So they took the difference between the 1 and the 7 and said, well, we're going to take that value, which should have been interest you paid, and we're going to tack it on to the principal of your mortgage. So for the next X period of time, yeah, you get the benefit of this low payment. And that's kind of where you were talking earlier, Narbik, of how the value of the loan or the principal amount that you owe can actually increase even though you haven't done anything.
And the irony to that is, as it's increasing in principal balance, there's a limit or there's a cap on that, which I said is 110%. That means if you have a $500,000 loan, and if $50,000 of it, which is 110% of the loan, so that means if your loan hits $550,000, you're not allowed to make that minimum payment anymore. You have to pay the 7% or 8%.
So and this is where a lot of people now have run into the situation where they can't afford to pay their mortgages, right?
Right.
So now we get into this foreclosure situation, and we've seen all of this problem, et cetera. And isn't this what the housing rescue bill was supposed to try to solve?
Yes, it was, and unfortunately they missed a lot of steps. The Housing Rescue Bill, they provided funding to the lender, and then they provided funding to counseling agencies like myself, which I think is probably one of the best things they did, because now consumers have a free resource that they could come to get qualified help. But other than that, the modification process it varies between different lenders. So there's no streamlined process right now where a counselor like myself or even a broker that's doing a modification, they don't have any guidelines. So that's the frustrating part.
So let me see if I get this. The housing rescue bill was passed, and it was intended to do what?
Well, it was broken down into quite a few things. One of the things was a $7,500 tax benefit or tax credit to first-time home buyers, which would encourage first-time home buyers to buy homes. But again, this was a kind of a loan that they had to repay back in 15 years.
Right.
But still, definitely a good step to take. The other thing was, which was the highlight of the Housing Rescue Bill of 2008, which was for lenders who were willing to write down their loans up to 90% of the current market value, then the federal government would step in and buy these loans from the lender, freeing some extra cash.
So this would be for those homeowners who were running into a problem and were finding that either their mortgage had reset, or they had had some crisis in their life and they weren't able to make the payments, and instead of going into default and foreclosure, they might be able to.
Correct.
Okay, but it didn't work out so good? Go ahead.
No, it didn't. They did come up with a program. It's called Hope for Homeowners. And this program is a refinance program, and it was intended for consumers that have these types of loans to be able to refinance, and the lender was to give a reduced principal balance write down, and they would refinance up to 90% of the current market value. Well, it was supposed to be October 1st was the release date. Everybody was ready. Consumers were excited because they thought they had an alternative now. But the lenders are not participating.
The lenders are not participating.
One thing we need to tag along here, one of the biggest clauses on the 2008 Housing Rescue Bill was it was at their own discretion. So it was an optional kind of a clause if a lender was willing to write down.
So we'll help you maybe. In other words.
So if the lenders will, now we have some areas, especially in California, luckily in the Bay Area, we're very safe. We haven't seen a drastic price decrease. But if you go to the outside of the Bay Area, like Stockton and Fresno, houses depreciated a lot. So if somebody had a $500,000 loan amount where the property values are $300,000, taking that $300,000 to 90%, that's a major write-down for the lender. So they're not willing to cooperate that easily.
So some of the statistics that I've seen, we're talking about the fact that now we've got this next wave, the pay option arms that are starting to recast, et cetera. And I saw some projections that said that somewhere up of 70, they're expecting like 70% or more of these things are going to be problems, and they're likely to go into default too. I mean, is this realistic?
It's very realistic. With pay option arms, they normally adjust every year. And what's happening is that they're adjusting and they're recasting, and the lenders are not giving people the options to get into other types of loans. So this product has been eliminated. So with the elimination, there's not a lot of choices out there for the consumer.
So they can't do another one of those kinds of loans, is what you're saying, and they're back to the fixed rate 30-year or 15-year, but then you have to qualify for that.
Well, one thing we need to remember is on the subprime loans, which were 2-year fixes, the interest rates were somewhere around 5-6. So it was in line with what the market had in terms of interest rate. It's just it was a shorter term. But when we talk about the pay option arm, these interest rates are like 1.92%. So how much does the lender have to bring down the interest rate for the homeowner to be able to afford the payment?
Right.
So that's the biggest obstacle for the lender, is that if you have a person that's having trouble paying a negative loan like this, then they're going to have a hard time qualifying for a loan modification or any other loan program out there.
Wow. So the homeowner is really between a rock and a hard place. There's not a whole heck of a lot they can do. Is that what you're telling me?
Well, again, as Keisha mentioned, it's what we're experiencing right now is truly history in its making.
That's true.
We're looking at interest rates at historical lows. In the 37 years that the Federal Reserve has been keeping track of interest rates, we've never been lower than 5%, and yet here we're hitting in the high. We're at the high 4s. We're going through a loan modification experience, which I don't think anybody had experienced in the past. Just staffing and learning how to do this concept. So, there's its pros and cons to this thing, but overall, the lenders. Certain lenders are now accepting the fact that they might be better off allowing loan modifications to take place rather than take the home into foreclosure, because the costs behind the foreclosure is way higher than what they anticipated in the past. There are attorney fees, they have to rehab the property before they can sell them. So if you add them, it goes into 6 digits.
Sure. And we're seeing that there's a lot more that are out there, and I don't think there's been a huge decrease in the number of foreclosures that are coming forward in a month-to-month basis. And based on this chart that we have over here, it looks like there's a high probability that we're going to even get an increase again. So Keisha, in your experience now, you had mentioned that the different banks have different programs and things like that, okay? So are you seeing that they are becoming more and more willing to work with homeowners to try to help them through these troubled times?
Some banks are, some banks aren't. It's just that simple. Some lenders are more flexible than other lenders, and each person's circumstance is different. They do evaluate each borrower on a case-by-case basis. So a modification is meant for a person with a hardship. So the consumer has to be able to explain and prove that they have a hardship to qualify for a loan modification.
Okay.
So and then the lenders will look at credit reports. So when you do a loan modification, they pull the credit reports. So if you're only defaulting on your mortgage note and you're paying your credit cards, your car note, they don't see a hardship because.
Really?
Oh, yes.
So you have to be really messing up everywhere for them to consider it a hardship?
Yes.
Well, I think it would be good for us to talk about, to define hardship a little bit. The lenders are looking for, and you would know better, as far as I know, the couple are like forbearances and loss of job, or I think, Keisha, you can cover a little, touch a little bit.
Yeah, we have a slide here with hardships.
Well,
okay, you don't.
I don't know if we have that, but we did have something that you had mentioned in terms of examples of what a hardship is that lenders consider when they're looking whether or not they'll work out a modification for a loan.
Right. They will consider illness, loss of job, and with loss of job, they want to see that you have filed for unemployment. So I always tell people, show them your unemployment statement. With a loan modification, credit is they look at the credit, but credit is not the deciding factor. They look at a failed business. If you have had a failed business, reduction in income, reduction in value too of your property, because they know if you owe $500,000 on your property and now your property is worth $300,000, that's definitely a hardship. They also look at if your loan is going to reset. That's considered a hardship.
Sure, because if it's going to go from a payment of $2,500 up to a payment of $5,000, that's huge.
Right. Right.
Okay.
So they are aware of the hardship, but they do want you to explain your hardship to them, and they will, and that's why they ask for a hardship letter.
Hardship letter.
So the
okay.
hardship letter is very important when trying to qualify for loan
I want to
modification.
make sure that the folks in the audience remember that when we have these kinds of discussions here, that we actually are in a position to forward information to you if you want more data about the kinds of things we're talking about. You can email us at info@referencepointtv.com, state your question, and we'll make sure that that information gets to Narbik or Keisha or whomever depending on the topic that we're talking about. And especially with this kind of subject matter here, because there's a lot of territory we're covering, and this area of hardship is an important one. And I want to talk a little bit more now about this thing you mentioned, a hardship letter. And let's talk. We got a little bit more time in this segment of the show here, so let's talk a little bit more about what it means and what is a hardship letter.
Okay. A hardship letter. Normally, you want to answer 3 questions in your hardship letter. 1, what is your hardship? Do you want to continue to have your house? 2, what have you done to restructure yourself? And are you out of the hardship? And they want to see income. You have to be able to verify income. So if you're self-employed, and there's a lot of we're in Silicon Valley, there's a lot of self-employed, a lot of entrepreneurs in Silicon Valley. This is where I'm kind of seeing the weakest point of the modification process. Lenders want to see full doc income. They want to see verified income and taxes. They do ask for taxes, and they go off your net income on your taxes.
Income. Oh, okay. So
Yes.
they're looking for your W-2 forms if you're employed,
Right.
but if you're a business owner and you've successfully managed to decrease your tax liability by showing a lower rate, you get
help.
nailed.
Right.
And it's that's tough.
Right. So it's a catch-22 because when you got the loan, you didn't have to do it. So now
Right.
they're asking you to prove it.
Right. I think this is a key point. We've talked about this a couple of times, and we've mentioned, but I think it's a key point that if the difference between what the concept of stated loans was and what the what are you calling it now? You have to
fully
documented verification. That's a huge shift in the way that the business is transacted now.
It used to be like this. Unfortunately, after 2000, these stated loans became very popular because values were appreciating and nobody was anticipating values to peak. So, and these loans were issued, bundled, and sold overseas to, so many lenders or banks out overseas in China and Germany. And you can read about the German banks are going out of business because of the subprime crisis here in the United States.
Yeah. We're going to want to talk more about we kind of started on a topic of what does someone who is confronted with a mortgage problem and they are hoping to be able to get their loan modified. What can they do? What services are offered by your organization and others that can maybe assist them? What can somebody do if they're already in the middle of a foreclosure activity, and how does that impact things? We're going to want to talk about this, and we're going to really pick this up in the next segment. Okay, we've just got a couple of minutes left in this segment of the show, but I want to let the audience know that that's what we're going to be addressing coming up. So the one thing that in the last couple of minutes here I'd like to talk about is organizations like yours, like EPA CANDO. I use the acronym because trying to remember the whole. You're not the only organization of your type here in the San Francisco Bay Area. Is that correct?
Correct. There are nonprofits all over the Bay Area. San Jose they have a handful of nonprofits out there that's given free modification counseling. The nonprofits, we deal with the lenders, we help you negotiate, we help you develop a budget, we help you develop a plan, and we present it to the lender for you.
That's fantastic. And you had provided me, Keisha, with a list of some of these companies, and I want to let the folks know that if you're interested in finding out who a nonprofit organization that can assist you might be in the Greater Bay Area, we've got a list of about 15 of them here, and we can send that to you. If you happen to know someone who's located in Sacramento or the Central Valley or any place else in California, we have a full list of organizations all over the state. So if you have someone in your family or a friend that you know that might need some assistance, we can certainly do that and get you that information.
If I may, I wanted to add something, and it's definitely a valuable tool for people who are in hardship, who need help to go through these organizations because they have the experience.
Right.
And it's not going to cost them.
Right.
They have the experience, they have the training, and a lot of the nonprofits, they have developed relationships with the banks. There are brokers and attorneys that are offering this service for a fee.
For a fee.
For a fee. If a broker approaches you, I would suggest that you go to the Department of Real Estate and see if they have an advance fee on file. Brokers are required to have an advance fee agreement on file with the Department of Real Estate before they could collect any money for a modification for consumers.
Why would a consumer go to someone that's charging them a fee for this if they can go to an organization like yours?
Well, I believe, because we just started doing this in March of 2008. So we're just starting to do this. So a lot of the nonprofits just got the funding. They're just getting the structure in place. And a lot of people don't know that we're here.
Oh, okay.
But again, it's important for people to use organizations like EPA CANDO and even partner up with somebody and try to initiate it by themselves. It's not a very complicated thing, but obviously having the proper guidelines, guidances helps a lot. Because it's a one-time shot. Either you get approved or you
either
don't.
get approved or you don't get approved.
And it's free.
And it's free.
The lenders, each lender has a loss mitigation department, and they will send you the documents that's needed to do it.
Okay. So with that, we're going to wrap up this segment of the show. And when we come back, we're going to talk more about what it is that someone who might be in a foreclosure situation can do, some of the additional services that organizations like yours have to offer, and hopefully give some people who may either be in a situation or see that train coming down the pike something that they can do to help. So folks, tune in on our next episode of Reference Point, and thank you for being out there, and we really appreciate your watching the show, and we'll see you next time.